Welcome to Disciple Well Strategies. My name is Austin Garner. In this video, I want to share what the ideal features are in an IBC style life insurance policy that may be helpful for you when you're selecting which life insurance company to work with. And if you've come to believe, just as I have, that the Bible does instruct us to control the lending function in our lives on an individual level, and if you've further come to believe that the Nelson Nash's IBC, the infinite banking concept, is the absolute best way for us to do that, well, then naturally the next step is to learn about the policy features and the structures, the different structures that are available when you're considering the IBC, and then will help you identify which companies might be more conducive to work with. And so that's what this video is all about. I'm not going to name names of insurance companies. I just want to simply share what the ideal features are and what's available to help you make the best decision you can. The information that I am going to cover in this video is actually the very same presentation I go over with a prospective client well before we review any illustrations. Because, if we're going to look at an illustration from a particular company, well, why that company? And so I always take the time to go through this presentation with prospective clients before they even know what company we're going to go with. Up until then, it doesn't matter what company I go with until a client understands what criteria I'm looking for based on their circumstances. So let's get into it. Criteria number one is, just as Nelson said, that it should be a mutual company versus a stock company. A mutual company is owned by the policyholders. Therefore, the owners and the customers of the bank, of the insurance company, they're the same person, right? Versus a stock company, they are owned by stockholders, which can be different than a policyholder. And in my opinion, what it seems to me is that every company, life insurance company, any business, they're always trying to satisfy their owners. And it's no different in life insurance. So the people who run a mutual company, the leaders, the executive teams, the administrators, they're obviously they're trying to provide a good product and service. But it's really the owners are receiving the profits from the company, and it's the executive's job, it's the company's job to produce profit for the owners, right? So if it's a mutual company, well, then they're trying to satisfy not only customers that is going to continue generating profit, but they're also going to be trying to produce that profit for the benefit of the owners, which are the policyholders. And a stock company, they're also trying to satisfy and produce profit for the owners. It just happens to be the stockholders, not the policyholders. So that's just my estimation of why a mutual holding company or mutual company is a much better option than, for instance, a stock company. But if you only have access to stock companies, then by all means, life insurance companies is still a viable solution to practice banking. It's just mutual is preferred. So here in America, we have mutual companies still. So that should be the priority. In places like Europe, all the life insurance companies have demutualized. So they're all stock companies now. So, use what you have. But if you have the option, choose a mutual company. All right. That's criteria number one. Number two is that they should have at least 100 years of consecutive dividend payments, a history of at least 100 years of consecutive dividend payments. I mean, think about what else happened in the last 100 years or 100 plus years, maybe 120 years. You think about all the famines. Think about all the economic cycles, the depressions, the booms, the busts, the wars that we've experienced. The oil embargoes. There's so many things you can think of, and even amidst these chaotic times in our country, in the world, good, solid whole life insurance companies consistently and consecutively have paid dividends. A dividend is a surplus. It is, that means that they are still profitable. They're still producing profit even amidst these chaotic times. That sounds like a pretty well-run company to me. So that was the second criteria that Nelson himself said was a priority when considering which company to work with. But then think about what's going to happen in the future. So I've had some people question the viability of whole life insurance as a solid asset because they're speculating that it's an asset just like all the other assets that are denominated in United States dollars, and they speculate that the dollar is going to collapse or that it's going to change somehow in the near future, which could be true. But let's not forget that throughout our history, our money has changed, right? I mean, go back to the founding fathers. What was our money? Well, at that time, they didn't even have a United States Treasury, during the Revolutionary War. So the money that was circulating in our economy before the United States Treasury was created that minted the dollar, I mean, it was gold and silver from Europe. Spain was one of the most popular gold coins that we had. But even after our founding, gold and silver was specifically chosen as the primary medium of exchange. And there were a few attempts like to use fiat paper currency, like the Continentals during the Revolutionary War and the greenbacks from the Civil War. But I mean, as you learned in history, they didn't do very well, so they didn't last long. So gold and silver were the primary means of exchange back then. Well, I mean, we had a few attempts at a national bank, the first and second National Bank of the United States. Their charters expired and were not renewed by the government. But then in 1913, the Federal Reserve was created and established. And now at that point, from since then, they have been in control of issuing our currency as a country. And they are not a government entity. They are a private centralized bank entity owned by a group of other global banks and which are owned by wealthy families, global families. But now the Fed now controls the issuance of currency. But then in the 1930s, we know that the president at the time, Franklin Delano Roosevelt, actually made it illegal for citizens to own gold because gold was still being used as a means of exchange, as a money. And even though we had paper fiat currency circulating, gold was still considered a money, a currency. But in the 30s, FDR made it illegal for citizens to own it and therefore trade with it. And he actually confiscated the gold from United States citizens. And, let me clarify. He actually did pay for it. He paid United States dollars, Federal Reserve notes. He paid Federal Reserve notes to citizens for the gold. But the reason I said confiscated is because right after all the gold was confiscated, he increased the dollar price of gold, therefore devaluing the currency that he paid to the United States citizens, which in essence devalued the currency. It caused every individual who sold their gold to the United States, it caused their purchasing power to decrease massively overnight. So there again, money did change. I mean, even though technically gold was still the backing of the United States dollar, that's an example of how it was confiscated, and how it changed, and continued the transition to a fiat paper currency only. But then after World War II in the 40s, the whole world agreed through the Bretton Woods Agreement that the United States dollar should be the world reserve currency. And as it was in the United States, it was advertised to be still tied to gold, even though the Federal Reserve printed massive amounts of money, inflating the money well beyond what the gold reserves were. But this caused an issue later when other countries started cashing in those dollars to claim their share of gold that the United States held in reserve. Well, obviously, the Federal Reserve and our government did not want gold to flow out of the country in mass droves as it was. So in the 1970s, Richard Nixon officially closed the gold window by delinking the money, our money, and gold. And so now we were officially off the gold standard, and it was just the paper currency at that point. So my whole point in going through all this is to demonstrate how our money has changed, at least materially. It's still called the dollar. And likely, if our money does change in the future, it may very likely still be called the dollar, but just have some kind of material difference. And regardless of what the money is, valuable assets will always be valuable, regardless. So when money changes, all assets will be revalued in the new currency proportionately. And well-run whole life insurance companies, they're going to continue paying dividends to policyholders. And they're going to continue paying death claims to their beneficiaries in the new currency. I hope that makes sense. And I hope that's beneficial. Hope I made my point clear as well. But that's point number 3. Criteria number 2. Criteria number 3 is Nelson didn't clarify this in his material, but this is getting into more personal preference. Non-direct recognition versus direct recognition. I prefer non-direct recognition instead of direct recognition. So if you have a policy with a direct recognition company, it's not the end of the world. It'll still function fine for you. But what the difference is, a direct recognition company, if you have an outstanding policy loan on the cash value, collateralizing the cash value of that policy, once a dividend is declared from that company, they will reduce the dividend proportionate based on the outstanding policy loan that you have. So, supposedly they have some formula that helps mitigate this, so that you still get the opportunity to participate in the full dividend or the full performance of the policy. But to me, it's just playing games with numbers. To me, it's not necessary. So I prefer non-direct recognition, which means that if you have an outstanding policy loan, it doesn't affect the dividend. So the company, once a dividend is declared, they're still going to pay a full dividend to you regardless of a outstanding policy loan or not. So they manage them as two separate cash flows, and it just simplifies the process, and it makes sense to me. Direct recognition really doesn't make sense, and why that would be beneficial. Just leave the dividend alone, simplify it. So personal preference. As I mentioned, it's not the end of the world if you have direct recognition, but if you have either option, I prefer non-direct recognition. All right, criteria number 4. Long-dated level premium term rider. That is, if it's needed. When you read through Nelson's material, his books, listen to his seminars, or watch videos of him, he never mentions term riders on whole life insurance policies. And really he didn't need to, because when he wrote his book in the year 2000, it wasn't necessary. But since then, since the year 2000, A lot of things have changed in the financial world. Interest rates have come down. You had changes to mortality tables a couple times. You've had the 7702 tax code changes. So several things have changed that have affected whole life policies. And so now sometimes it may be beneficial to use a small term rider on the policy. And the whole purpose of utilizing a term rider on that's attached to a whole life insurance policy is so that you can temporarily increase the death benefit so that you can pay the level of premium, the PUA premium that you want to pay, without causing a modified endowment contract, without causing a MEC. And obviously the whole goal is to generate substantial cash value. And so as I mentioned in other videos, a modified endowment contract is simply a life insurance contract that has lost several of its tax efficiencies on the living benefits, on accessing the cash value through policy loans or withdrawals. And as an example, if we're considering quote unquote banking with these policies, well, if you go to take a policy loan or withdrawal and your policy is now classified as a modified endowment contract, well, then you are subject to taxation on that withdrawal or that policy loan. And if you're younger than 59 and a half, you could incur a 10% IRS penalty. And so the treatment that they give these MECs is just like an annuity. They basically treat this life insurance contract like an annuity at this point. And so it's not as tax efficient as a whole life insurance policy. But a MEC is still a life insurance policy. It's just the living benefits, the cash value is now treated similar to the proceeds or the cash value of an annuity. When you access them, you get taxed on the gains first, and you also are subject to an IRS penalty for early withdrawal. Now, the death benefit of the life insurance policy is still tax-free to your beneficiaries. It's just on the living benefits, the cash value. So for the most part, we want to avoid a MEC if possible. It's preferable. If we're practicing IBC, we want substantial cash value. We want to be able to access it tax-free on a tax-free basis for the rest of our lives, and as well as the tax-free death benefit. So we want to avoid it as best we can. It may be beneficial to utilize a term rider for a period of time to mitigate this issue. Now, when you look at the various term rider options with various companies, there are a few options to choose from, and I prefer this one, the long-dated level premium term rider. There is another popular option that is a annually renewable term, and then there's also a blended PUA term rider. They basically function the same because they're using the term rider they're using is annually renewable term. So an annually renewable term is just as it sounds. It's a 1-year term policy. It gives you 1 year's worth of death benefit, and then at your anniversary, you receive a new 1-year death benefit with it's the same death benefit as the prior year, but as you can imagine, each year you're getting older. So therefore the premium for that same level of death benefit could increase. As a matter of fact, as you get older, it will increase to the point where it may be beneficial for you to terminate that term rider prematurely. To me, that's not necessary. So I prefer a long-dated level premium term rider. Just think about this for a second. If my goal is to have the ability to pay as much premium as I may want to pay, with a very significant portion of that premium designated towards PUA, And at the same time, I want to avoid a mech. I don't want it to be to cause a mech by paying that large premium, that PUA premium. And I want this ability for as long as possible, preferably the rest of my life. Well, if the term rider is helping me have this ability to pay a little bit larger PUA than I otherwise could have, and I want to pay PUA as long as possible, well, doesn't that mean I want the term rider as long as possible as well? I want it to stay in force as long as possible? Well, yeah, I want, if I can get a 30-year term rider, that's what I want. And if I'm too old, I want a 20-year. I want the longest one possible because I'm trying to pay as much PUA that I can for as long as possible. And also, since I'm getting older every day and my cost of insurance is going to go up every day, I would prefer the premium to stay fixed. I want it level, so I do not have to worry about it getting so expensive later in life as I get older. So that's why I prefer long-dated level premium term riders. I want it for as long as possible, and I don't want the premium to change. So hope that makes sense. All right, criteria number 5 is a contractually favorable PUA rider. What I mean by contractually favorable is, first of all, that it should have a low minimum premium, as low as possible, preferably as low as 0. Not likely, but I want the lowest minimum premium as possible. You know, when I design the contract, I'm establishing what the maximum is that I want the ability to pay. Well, the company ought to allow me to pay as close to 0 as possible to give me the most flexibility in how much I can pay year after year. And some companies, it's a set percent, like you have to pay a certain percent of the base premium or something like that. They have different rules with different companies that don't give you as much flexibility in how much premium you can pay each year. Those companies they'll work fine, I suppose, but I just prefer to have the most flexibility on how much premium I can pay, how much or how little I would want to pay in each year, depending on my cash flow. I don't know what tomorrow holds, so I want as much flexibility as possible. And then the second thing is the flexibility in the frequency in which I pay premium. So some companies, I have a very small window of when I can pay. Some companies only allow me to pay PUA on the same modal schedule as the base policy. Okay, well, that's not very flexible. Some will give me a window throughout the year that allows me to pay periodically throughout the year, but it's not any time I want. They're very select windows. That's not preferable either. So my preference is I should be able to pay PUA whenever I want. Whenever the cash flow comes in, whenever I have it available, I should be able to pay it whenever I want. That's going to give me the most flexibility, the most control in my hands. And then thirdly, the PUA should have a catch-up provision. And that's beneficial because, if one year perhaps I can't pay the full PUA premium, but in the next year, I'm not only able to pay that year's premium, but perhaps I want to go back to the prior year and catch up last year's premium. I would love that. I want that feature, because that gives me more control over the policy, over what I'm able to do. So these are the 5 primary criteria that I look for in in which company to work with. And so these become the measuring sticks for which I determine which companies to work with. And, not all of them are excellent in each of these criteria, but there are trade-offs. And so you should know what the trade-offs are. If they don't perform as well, if their criteria if one of these criteria they don't do very well, is it worth it because of one of the other features they offer that may be more beneficial to you? That's possible. But this is my starting point. This is my foundation. What do I look for in a life insurance company to practice the infinite banking concept? So, in conclusion, if our whole desire is to control the lending function in our lives as individuals, the way the Bible teaches, and also the way Nelson Nash demonstrated with mutually owned whole life insurance, well, we need to know what the ideal features are. The features that we prefer to help us choose the right companies that are conducive to the IBC. So I hope this video will help you do that. I hope it'll help you narrow down the vast field. And as you can imagine, as you start going down through these criteria with the various companies, the mutual companies out there, as you can imagine, that list gets shorter and shorter every time you add a new criteria on it. So it is a filter system that is very helpful. And so I hope it helps you. So that's it for this video. Thank you for watching. If you have any questions, feel free to reach out to me. I'd be glad to connect with you and answer any questions you have. So until next time, thank you for watching. Have a great day. Bye.